Wall Street again rattling the local stock market. Is this a buying opportunity they're making, or should we be frightened? The man who can allay our fears or scare the pants off us is Matt Sherwood, Head of Investment Market Research at Perpetual. How are you, Matt?
Well, Pete, yourself?
Good. I think you can be more personal than Matt. You don't talk stocks. That's not. People read you at Perpetual, then they go and make their stock decisions, and they wouldn't move unless they listened and talked to you. What do you think's going to happen, mate, on stocks this year?
I think we're going to have a pretty flat year. And the reason for that, for the last 2 years, we've had very strong rises in prices and not a lot of follow-through in earnings. And I was having a look at it today. So since the lows of September 2011, so we're talking about just over 2 and a bit years, the US market's up 63%, earnings are up 15%. Now, in the rest of the global share market, prices are up 43%, earnings are down 4%. So the difference between those two is around 47, 48 percentage points. Now, that's a lot. And you typically see this at the start of a market recovery, not 4 years into it. So I think what we're just seeing at the moment is that markets have run ahead of themselves. The global economy is clearly getting better, which is a good backdrop for markets.
So my Bill Clinton comment was relevant.
I think
it is the economy, stupid.
And I think it's just going to take a year for earnings to catch up with valuations, and this will set up better 15s and 16s.
Yeah, that's the thing I'm thinking about here. Like, our market's kind of in catch-up mode, and we might do 7 or 8%, maybe 10, who knows. Adding on the dividends, it still could be a pretty good year for a country whose stock market hasn't passed the old high. But it doesn't look like it's going to be a shoot the lights out year. But to my way of thinking, Matt, and what you just alluded to then, is that maybe we could be in a climbing up mode for a long time, but not shooting the lights out, and which wouldn't be bad.
Well, that's, I think, going to be the case because, as I said, even in Australia, we've had, in the last 2 years, we've had gains of 15% and 13%, and during both of those years, earnings per share actually declined. So, again, I think it's going to take time for the earnings to catch up with the valuations, and, of course, I think that gives investors good opportunities, particularly if the market's coming off a bit, to actually use that as a better entry point. And so the clear message for investors is be patient, pick the quality businesses when the valuations are right.
Yeah, so what you're saying then is that if we are in a bit of a correction, an overdue American correction, and you see a stock that you really like, this is a quality company, it's a buying opportunity.
Absolutely. I mean, I love declining markets because, it's kind of like the kid in the candy store when he's found, $1 or $10 on the side. And that is, you can buy more companies, there are more opportunities, so therefore you can better decipher an investment strategy to put in place for many years ahead.
Yeah, and you're a young man with plenty of years ahead of you, so you're investing for the long term, aren't you?
Absolutely.
All right, let's try and work out the reasons why America is nervous now. Now, let's go through it. Tapering. Tom just said maybe there's talk that they might taper more aggressively than expected. I don't think was this going to be Bernanke's last shot, isn't it? Even though Janet's now she's not in the seat yet, but she's pretty well going to take over into this month, isn't she?
That's correct.
Yeah, if he starts tapering, he's only going to do the 10 billion, isn't he?
Well, I can't see anything that's really changed in the US economy over the past month, or the past 6 weeks, that would culminate in a stronger taper. Let's face it, the payrolls data was disappointing because of the weather. The housing market data was disappointing because of the weather. So at the moment, we're in a bit of an information vacuum because the January data is also going to be weather impacted. So we're not really going to get the new data about the US economy where it's at probably till March, in all honesty. So to me, if they did continue to taper, it would be in very modest step. And they only did 10 billion taper in December. So to me, if they do it at all, it would only be by a similar amount.
Okay. China. Are you worried about China, or have the expectations been too high, but are they going to grow around 7%? What do you reckon?
Look, I tend to think what's happening in China is the fact that the government is trying to set a growth benchmark that it can only meet by inflating investment and credit bubbles. And so what they've initiated June last year, and I think China's got more to do with the global sell down we've had in markets than the US.
Yeah.
What we've had in China, most people, I should say, look back to June last year and the talk at the taper talk started.
Yeah.
You know, markets came off and Bernanke corrected himself and they gave, you know, a bit more. But what also happened at that exact same time was that China started to implement tightening measures in its financial system.
Yeah.
They warned shadow banks that if they default, they're on their own. There won't be bailouts. So I tend to think that we are getting a slowdown in China. It's going to be bigger than what the market's expecting. It'll be below the growth target by the end of this year.
That's 7.5, isn't it?
Yeah, but 7%, you know, in the end, still very good growth. And I think when we actually have a look at it, it means China's growth's more sustainable, and at the same time, the US growth is accelerating. So this is not anything for markets and investors to be concerned about, other than the valuations which are currently in there, and they're starting to come off. The market ran ahead of itself, so I tend to think that, you know, the China slowdown and risks about the quality of the shadow banking sector are going to weigh on sentiment for some time, you know, and markets may come off for the next 6 months. But if you're long-term investors, that represents good opportunities.
For sure. Now, the emerging economies issue. Now, it's been linked to tapering, the idea that if the Yanks taper, interest rates rise in the US, money gets taken out of emerging economies, goes to the US, and emerging economies are losing money, their currency's dropping. Yeah. Is this a currency crisis waiting to happen, or is this going to be a bit of a currency hiccup?
I tend to say, you know, the problems in the emerging markets are, in some of them, a bit more profound. We're not going to get a repeat of the 1997 Asia financial crisis, where there was wall-to-wall problems in the state of financial systems.
It was an Asian contagion, wasn't it?
That's correct. We're not going to get that, but I think, you know, economies like Brazil, Turkey, which has got problems with the lira, Indonesia, India, South Africa, they're the economies and the emerging economies which are going to struggle, because most of them are trying to fund current account deficits, and that's easy to do when US monetary policy is cheap. But as interest rates and, as you said, capital flows go to the US, they need to raise their interest rates to attract the capital, which of course hurts the economy. Yeah. So the worst thing they can do, and the Bank of Indonesia has done it, the Bank of India did it today, they raised interest rates. Yes, that might address your currency concerns, but it's going to hurt the domestic economy. And central banks' best path forward in this environment, I believe, is to say we're going to have a more extended look at inflation. We're not going to be worried about short-term inflation. Any impact of the currency should wash through within 12 months. But they've tightened rates, and of course the economy there is going to struggle more.
Simple question: are you expecting an economic Armageddon related to this currency crisis?
No, I don't. And the reason for that is, in the scheme of things, the US growth's looking better. China's growth's looking more sustainable. You know, it is slowing down. Yeah. China has issues, but in the end, you and I have talked about it before. They have a closed banking sector, so any problem in a bank can easily be solved by just moving capital from one side of the Chinese government balance sheet to the other side. Yep. So in the end, the only impact that could come out of some kind of financial problem in China is on regional confidence, but we're not going to get a repeat of a Lehman-style situation.
Communism is not all bad. Let's go to US earnings. Some people say, oh, look, part of the sell-off is US earnings have disappointed. I've been saying it looks underwhelming, but not terrible.
I think that's precisely the case. We've had some disappointing results, for example, out of Citigroup, out of Intel, and today we had a disappointing one out of Apple. Now, it made record earnings, which investors should be pleased about, but it missed on iPhone sales by about 8%, and what we saw in after hours trading, the share price came off 8%, so that's going to be a bit of a headwind for the market to digest today. But at the same time, we've had good results from firms like Caterpillar, and also...
Which is a good benchmark company, isn't it, Caterpillar?
That's correct. Yeah. You know, and also other stocks in the the US financial system. You know,
Wells Fargo did well.
Did well. JP Morgan.
Bank of America.
You know, Bank of America did well. So in the end, I think it's been more mixed, but there's more firms missing on earnings guidance, on revenue, and so in the end, I think you're right, it is underwhelming, but that's just relative to very lofty expectations, and I think the market is going to compress their expectations down, and share prices will probably move down with it.
Now, Matt, when I was doing my comment, you nodded when I was talking about Germany and the UK. Germany got a good industrial read.
Yep.
The Poms cricket team's doing badly, therefore the economy must be doing well. I noticed that when the economy was hopeless, all the athletes were good. Olympics, cricket, but now, flip side around, UK economy is coming back.
It certainly is, and I think the Cameron government should be really congratulated for the reform process they put in place. It was highly controversial, but when you can see that light at the end of the tunnel, you can see that all of those reforms have been very worthwhile. And when I actually look at the major economic regions, the best growth improvement that I can see in the next 3 years is going to be in the UK. It's going to be stronger than what we get in the US, stronger than what we get in Europe and Japan off very low bases. So in the end, I tend to think that the Bank of England is soon going to have to start unwinding its forward guidance, and we've seen the Bank of England governor already start to talk about this. So that tells you, in the end, that things are looking better there.
Okay, let's just concentrate on the local economy. Your view, what kind of growth number do you think we'll end up? Looking at that NAB number today, do you believe it, or do you think it's a rogue number?
I think it's going to be very hard for those business conditions to hang on to those gains, particularly when you have a look at the employment indicators, the forward orders indicators. They were still indicative of very softish growth. I tend to think, though, that for most of this year, the economy's annual growth rate is going to remain around 2.5. It's not disastrous, and I do think we are starting to get a turnaround, particularly in the cyclical parts of the economy. Housing's looking pretty good at the moment, so I tend to think that there'll be throw-through of that into the cyclical parts of the share market, and some stocks in housing construction should do reasonably well and might have a bit more upside. And at the same time, the currency's coming off, so that's doing a lot of the RBA's job for them. So, since April last year, the currency's come off about 10 cents or a bit more, and that's the equivalent of 3/4 or 1% rate cut. So in the end, I tend to think that the economy is going to be a little bit soft and lacklustre, but I don't think it's going to deteriorate much further.
Okay, one last one. There's an expectation about 3 or 4 months ago that earnings coming up would be better than it has been. They've been pulled back a bit, but do you still think they could be positive earnings, or they've been negative, haven't they?
Yes, well, I think there will be positive. And the real wild card here is resource companies. If we get some kind of stimulus program in China, then of course that will boost their earnings. But at the time I was on the show, I had earnings, the market had earnings at 12, and I said they're going to be about 6, and the expectations are now of 7. And I think
they follow you, mate.
No, but I think they are deliverable. And in the end, I tend to think that any earnings downgrades from here might represent just a little bit of softness temporarily in the economy and in business models. And if it's a quality company, I think they'll improve in 15 and 16. All
right, Matt. Well, thanks for coming on the program. It's good to know that when you started on here, it's launched a media career, and you're everywhere now.
Oh, all thanks to you.
All thanks to you, mate. After the break, I'll speak to a controversial economist and maybe start an argument or two.